We certainly see it today in market prices and in everything that's happening. There are three, sometimes maybe we could stretch that to five, big things that are happening, and they are reflected in market prices, and the dynamics behind them and their change will be reflected in changes in market prices. And those three big ones are, first, that which is happening with money and credit. In other words, when you get close to a zero interest rates and you spend a lot more money than you earn, and the government does that, that means that a lot of money is printed and it moves its way through the system in a way that is reflected in market prices. And so that is what is happening now. The second is the very large internal conflicts that we're having that are due to wealth gaps, political gaps, and so on, that influence the left and the right and the dynamic between them. That affects tax policies, that affects capital flows and the like, and they're reflected in market prices and will change as those circumstances change. And the third big influence is the rise of a great power, China, to challenge the existing leading power and the existing world order. And that is being reflected in market prices, but will be reflected more as those circumstances change. The other two that have been reflected through history, and I didn't have a full appreciation of until I studied the last 500 years of history, those two are technology and inventiveness changes. We're accelerating the rate at which they are occurring, and that adaptability and change is affecting our lives in big ways. So you cannot ignore the technologically and inventiveness changes. And the fifth are acts of nature. You know, the one thing that was interesting to me when I studied the last 500 years of history is that acts of nature, and they could be climate related, droughts and floods and pandemics, had cost more lives and toppled more civilizations than anything else, including wars. So they are something that comes along irregularly. You know, when you have the pandemic or the drought or that event that comes along once in 100 years or so, they have had big effects too. So pandemic is a reminder of those. But those are the drivers, and they will remain the main drivers. And as they change, prices will continue to change. I think you have to look at the dynamic behind those prices, and I think I would look at them a bit differently. Regarding the dynamic behind those prices, it is that we are spending more than we are earning by a lot, individuals and the country as a whole, and that we need money, partially because of the political issues, partially for all the reasons that you know. So a lot of debt is being created that is also producing the need for a lot of money. And as a result of that, we have very negative real interest rates. Real interest rates of short-term interest rates are significantly negative, and even bond yields, real bond yields, are over 100 basis points negative. And so when one looks at the return of owning those bonds, that is a very bad return. It means that if you save in those assets and you put it away, that you will lose buying power at probably a rate of 3 to 5% per year. We can guess what inflation is, and we could talk about that, but you will lose that, and that tax on your buying power makes one not want to be saving in those assets. It makes one want to borrow in those assets, and the availability of credit and that set of circumstances drives money into other assets, and those assets are investment assets as well as goods and services. And so what we see now is that stocks are not expensive, not very expensive, maybe a little bit more so than normal, relative to bonds, which are very expensive, but still not expensive in relation to cash. And so they are all having expected returns that are comparatively low, and we have an inflationary period. So it's very important to understand the paradigm that we're in and how that dynamic works. And so as the inflation pressures become an issue and we have relatively, let's say, stronger growth, those things will start to change. And so the big question that the markets look at is how will that change as a result? Will the Federal Reserve and other central banks begin to tighten monetary policy? Because these things will change. And what will tax policies be and the like? And those things will affect market prices going forward. It's unsustainable. There's always, throughout history, a debtor and a creditor. And there's always, throughout history, the ability to create demand by creating debt and by creating money. And then there become clear preferences for doing one or the other. There are environments like the late 1970s when Federal Reserve Chairman Paul Volcker tightened money and wanted to make it good to save and bad to borrow and have credit. That set of circumstances was caused, and that action was caused by things that happened before it, high real interest rates and the like, and that produced the environment that we had, largely the disinflationary environment that followed. Similarly, the 1960s led to the 1970s. The 60s had too much debt creation due to war, Vietnam, and what we call guns and butters policies that were spending more than we were earning. And that led to the necessity in 1971 for the President of the United States to acknowledge that they would no longer be able to pay the dollar claims in gold and to default on the gold claim and to devalue the exchange rate and to devalue the dollar, which led to the 1970s, inflation and so on. So there are always, all through history, the dynamic in which there are high real interest rates and it pays to be a saver for some times. And there are times when there are very, very low real interest rates and the need to create a lot of money and credit. And it pays to have assets, the opposite side of assets, positioned in the opposite way. And that's been true throughout history. And that's the main driver. So I think when we look forward, we can use those as guides to what's likely to happen in the way of excess return. It's in fact the way the system works. In other words, investors, borrowers and lenders look at the relative expected returns of cash, bonds, and other asset classes and move their money between those things based on the relative pricing. And that's why, for example, when there is a rise in interest rates, a tightening of monetary policy, and short-term interest rates rise relative to longer-term interest rates, so the yield curve begins to flatten and so on, that we see that there's a slowing in the economy and a slowing in capital availability, lending, long-term lending. There's a shift to saving, and as a result, there's a slowing of the economy. That's, to me, how the system works. The market is it's like a poker game. I've played the poker game for over 50 years, and I'm saying it's a zero-sum game relative to what's priced in, and the smart people take money away from those who are less smart. And that's the way it works. I wouldn't be in the business unless that was true. The dollar as a reserve currency gives one the ability to print the world's money. It is both a good and bad thing. Being able to create debt gives you the buying power. Being able to print the world's currency, such as when we were in the COVID crisis, and being able to print the currency that around the world will be accepted, allowed us to sell more debt, because when you buy debt, it's somebody else's currency. In other words, when one owns debt, the buyer of that debt is owning your promise to deliver them currency. And when you have the world's reserve currency, it allows you to get into more debt. Now, getting into more debt has historically, if not done correctly or not done sustainably, in a way it creates obligations to pay back. And those obligations to deliver currency and pay back have produced different types of problems in the future. And so debt is very short-term stimulative and it's longer-term depressing. And the ability to do that and have others take on our liability As John Connolly said when he was the Treasury Secretary and the dollar was devaluing and a risk, the dollar is our currency, but it's your problem. It's a net benefit, but like most things, it's cyclical because you have to pay back and it produces problems sometimes when you pay back. So the United States is more indebted as a result of it being a reserve currency. And it all depends on, who's going to get stuck with that. There are two main sources of inflation. There's the usual supply and demand for goods, cyclical inflation, so that when there's a demand for something, that there can't be a greater amount of supply being produced for it. There's an upward pressure in that price. And so that comes from strong demand pressing up against capacity limitations. That's cyclical inflation. And it depends on how far the central bank accommodates that. So that's the cyclical inflation. The second is monetary inflation. When the production of debt is large, but the central bank produces more money and credit, that has the effect of devaluing the value of money and credit, which doesn't look like it is going down as much as it looks like other things are going up, so that you see things going up as they are now, and that's monetary inflation. I think right now we have both cyclical inflation and monetary inflation, so that if you look at the demand for everything, right now, the demand is greater than the capacity. It's really an excess demand issue provided by a lot of money and credit being put out. And we also are running large deficits. And as we start to look farther forward, we have these very cheap interest rates, which means that it pays to buy things like, let's say, houses. Practically, there's no interest rate to speak of. And now a lot of loans are made on interest-only loans even. So with hardly any interest rate and not having to pay back principal payments in terms of the amount of ridiculousness that it's gotten to that way, there's a lot of demand for those kinds of things. Now that could be cyclical, but I don't believe when I look forward that our deficits will be primarily cyclical. So I looked into the issues of politics and the issues of the deficits and the needs for money and credit, or the desires for money and credit. And I think that they'll be structural. And I think then also there are certain changes in expenses. For example, while I believe that climate change and moving to cleaner energy and other such moves is very good for our ecosystem in the long run, it's also very expensive. And it makes less efficiency. So that's going to, at that same time, add to inflation. So my worry or belief is that that will increasingly be built into the process, which we're seeing, for example, in terms of changes in compensation, changes in many, many things. Everybody's seeing inflation around them, and it's not just something that's going to settle back. So if I take the cyclical piece, it's going to require enough of a tightening, if you were to deal with that in monetary policy, to stop that buying. And the consequences of that would be very bearish for markets, and it would be very bearish for the economy. And I believe too bearish for the Federal Reserve to want to tolerate. And that would only deal with the cyclical inflation pressures, whereas at the same time, we have the structural issues of those kinds of deficits that need to be monetized. So for those reasons, I don't believe it's transitory, that we will go back to what we experienced before.